This is a promotional podcast for EIS Platforms Limited trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you're prepared to lose all your money. Hello and welcome to Alternative Thinking with Steve Dobson and Melissa Griffiths. This is the podcast that takes a deeper dive into the alternative marketplace and topical issues. So with me today I have Nick Priest from Downing and Paul Mattick from Mercia, and also covering the Northern VCTs. Topic today, spring budget. And what do we all think? Let's catch up first. Nice to see everybody.
Thanks for having us on, Mel.
Nice to be here.
Thanks for having me.
Okay, so let's start. Spring budget. One of the things that didn't come up, and I think there was a lot of anticipation for, was inheritance tax. Anybody want to start thoughts on this?
Yeah. Well, I think we were sort of expecting nothing to happen. It felt like a bit of a baiting session for the last two budget statements, and yeah, there was a lot of noise, but actually very few attributable quotes or very few attributable opinions on the whole story. So yeah, it felt a little bit like they were baiting each other to sort of take a lead, and then no massive surprises when it didn't really go anywhere.
Yeah, I mean, I had heard people were talking possibly a bit of a cut, but I think the media got so behind the fact that it really only affects about 4% of the population. So it's very much more for the high net worth individuals, isn't it? And not such a key voting.
So that's what I think we're sort of thinking about, the Trump effect, if you like. It's the only part of it that, from our perspective, that I was ever really concerned about is that only 4% of people of estates pay it, and yet every couple of years YouGov do a poll. Yeah. What's the most unpopular tax? I think the last one was 54% of people said inheritance tax, which shows the mismatch between reality and perception. And then I guess that's why I call it the Trump effect, because if you understand the perception, then the reality is sort of a bit less important, but it didn't really play out like that.
No, and I think that's what was encouraging, wasn't it? That it's almost putting it to bed now, and we hope that whichever government comes into play, they're not going to have a significant reason to look at IHT as much as possibly it's been flagged around before.
Yeah, I was just thinking that in terms of the scale of it, so IHT, whatever it was, 8, 10, 12 billion a year, compared to income tax, it's 250 billion. So it's so small in comparison that, yes, it does seem to be quite a political tax. You say it's very, very highly disliked by the public. It's an aspirational tax, whereas and there is some kind of room for difference across Labour and Conservative. Not want to go political, but there may be an option there for them to have a bit of a disagreement about that during the coming up election. But hopefully it will not be focused upon at all, and it will just be something that remains in the background.
Yeah, which I think would be great for us and particularly all the inheritance products in the tax efficient space. So let's move on. Then we also had national insurance. Paul, you did a great webinar where you concentrated. What were some of the key things you managed to bring out on this?
Well, for the second fiscal statements in a row, there's a reduction in national insurance. And that's great, and it's returning £450 to an average person, and each, say, £100 over the autumn statement and through the budget, which, yes, that obviously has an effect to everyone's pocket. But the thing that was really noticeable, that there was lack of change in the thresholds in income tax. I mentioned income tax already, but because of the lack of a change in the thresholds of each income tax bracket and the maintenance of the same rate, it means that people are being dragged through inflation, wage inflation, into higher tax brackets. So the net effect of reduction in income tax and freezing the bans on income tax is that we'll be paying more tax in the future. So yes, it's a reduction in NI, but actually income tax is going up effectively. So net we're worse off.
Yeah. And Steve, any further thoughts? Anything that really sort of noticeable for you from the budget at all?
Well, I think for tax efficient, it was the lack of information, I guess, any changes, to Nick's point on IHT. I think because of that now, we've seen a lot of people sitting on their hands and waiting to see what would happen. We've seen since the budget some cases come through for IHT through our platform, which I think is cements what's happened. But also, we've come through lots of uncertainty with many headwinds into the investment. We have a high interest rate environment. We've now had the surety from the sunset clause, and even if Labour were to get in, they've supported the IS and VCT schemes. So hopefully going forward, yes, we've got a general election coming up. We've got the US elections too, but locally, with the tax efficient space, no big change. It's probably positive for the industry.
Yeah. I mean, I felt that it was a budget which did seem to look at different areas as well. I mean, obviously with you guys here, we've got funds covering very different sectors. They touched on a number of areas, the creative industries, they looked at AI, there was green industries. All of this has got to be good for startup and where we're all looking to invest.
Following on from that, I think if I take the green industry, having just been on a webinar with the Green Angel Syndicate, and we're looking at the FCA fund labels, there's a lot of change to come in this space. And I think it's good change because it's going to help advisors when they think about talking to their clients, one, about ESG, but two, about differentiating different funds. So the labels are coming out. That's going to be July this year. We've got anti-greenwashing rules coming into play at the end of May, SDR disclosures. So there's lots of change in the space. There's been a lot of backtracking by the government as well in terms of, banning the sale of petrol and diesel cars and gas boilers from 2030 to 35, I think it is. So actually, getting some more detail and facts around ESG in the tax efficient space, well, in funds as a whole, has got to be good, I think, and the focus that the government is still focusing on, green, making sure there's investment in that area.
Yeah.
It's probably quite good as well. I mean, it's probably quite good for advisors to get their focus on this kind of thing as well, because there are responsibilities for them in all of this. Yeah. And having just been through this process with Consumer Duty, where there was a lot of nervousness really about what an advisor's responsibility would be through that. This is coming down the pipe with the schemes you're just talking about now. They're going to have to understand what their responsibilities are, and they have them, so they need really to be educated about that.
Yeah, I mean, I think a lot is education generally across the marketplace, isn't it? It's going back to the inheritance taxes, people actually understanding what is relevant to you and to your clients as well, and I think that's across the tax efficient space. One thing that I thought was interesting, the new British ISA. What are we thinking there? This is you're smiling, Paul.
Yeah, well, so I'm a member of the Enterprise Investment Scheme Association and on the board, and there is a consultation on the UK ISA, or the British ISA, but and the form of what this is going to take is to be confirmed. But the idea of adding an extra 5k on top of the 20k ISA allowance per person per year, I think it's really good. But I think the detail is going to be where exactly what goes into this ISA is to be confirmed. Whether that's big mega caps which are UK based or smaller companies, that's the unclear bit at the moment, and whether it's all investment trusts or just certain investment trusts, or whether the revenues need to be UK based or just the company. There's lots of nuance there about what qualifies within this UK ISA, and that is assuming that it comes into law. But I think it's a great initiative, and I think it comes in alongside the Mansion House reforms and trying to promote investment into UK-based companies, which is, I think, is fantastic, and it's what we should be doing to drive our economy, but also create these great companies which can build and grow and actually drive UK GDP as well as employment and hence tax take as well. So I think it's if it works, then it wins from multiple different angles.
I agree with you, Paul, on that, and I think the instant reaction to that is great idea. It's got to be really positive. Lots of people were behind this idea. We certainly were. But the devil is definitely in the detail for that. There are considerations that need to be made about, where people have got money allocated now. There's almost an idea that there could be a loophole in this where you can move money from your existing UK exposure across into this new ISA and then top yourself back up again. And those kind of things they'll just completely negate the point of it. So the devil will be in the detail to see how it pans out.
I will also point out that one of the big brokers, AJ Bell, were actually quite against it, which is a bit of a surprise.
Yeah.
And I can understand some perspective, and again, it's operationally complex. But I think the theory behind it is a good one, and to say whether it's pension money or ISA money coming into UK companies is got to be positive overall, because there's been a lot of money going into the US, etc., the UK ISAs and pension money, rather than investing into UK companies.
Well, you've got some good stats, haven't you? I mean, I do like stats, but you had some interesting stats about money moving away, pension funds out of the listed.
So I think it was 2006, the UK pension fund industry had 39% exposure to UK companies, and it's now currently at 4%. So there's a 90% of the capital which has been invested into UK companies is now across the globe, away from UK companies, which is kind of where these pension reforms are talking about, trying to require pension funds to invest more into UK companies. Great, and that's paralleled in many ways with this UK ISA, by the seams of it, to trying to get both pension money and ISA money working in the UK, which I think they're both great initiatives. And another stat, which I know you like stats,
I do like
is that Scandinavian pension funds invest more into the UK companies than UK pension funds, which is absolutely ludicrous.
Wrong. Yeah.
And it's just disappointing to see that everything's gone too far the wrong way. And then you look at how efficient we are in terms of growth and productivity, and compared to the US, it's much lower. And I think this is part of this question which we're talking about now.
Yeah. I mean, I have a statistic here. The UK government estimates there are approximately 35,900 medium-sized businesses in the UK, but only approximately 1,900 are listed on the stock exchange. Interesting, I think, in terms of, there is definitely not so many IPOs. We're seeing that a lot in the marketplace. I mean, it's again something that comes up with the EIS funds, isn't it? That there's not this need to...
Yeah. Tying that back in with the UK ISA, my first reaction was it's a positive thing, and then I've gone a little bit mixed. But why is it positive? Because of the capital going into the UK markets, it's going to make it a lot more appealing for companies to list. So looking at EIS VCT, there's an out. What are we looking for is exits, and it's that ability to exit, IPO being one of them. So if there's more appeal for a company to list on an exchange, well, actually, that's got to be good ripple down effect to EIS and VCT. The only bit that kind of gave me reservations was, I think, a point one of you made there was, let's not make it that the UK ISA is the only place you can put your allocation to the UK. You can still do it in your regular ISA. It shouldn't be, I can only put 5k into UK and the rest is going to something else. That's just an additional on top that has to go into the UK. You can still put your regular 20k ISA allowance into UK equity if you wanted to.
Yeah. The other thing I read was that it again, it's going to be more for the high net worth individual, isn't it? A lot of people are not using 20,000 allowance, so yeah, I mean, that's something else. And I think you had a statistic, Paul?
Another one, yeah. So
You're definitely inserted as the statter, aren't you?
Yeah. Well, Mel's a statter.
Well, I call myself Miss Statistics, but I think Paul's becoming stat.
Well, I listen to various
podcasts
podcasts like this one, I'm sure. But apparently 800,000 people per year max out their 20k ISA allowance. So it is a small percentage. So talking about less than, it's a little bit over 1% of the population. So it's a small amount, but having that extra 5k will be with the people who are the most wealthy. So perhaps they can afford to get a bit more exposure to UK and maybe to early stage companies as well.
Okay, now this is throwing something out there. It was more in the small print, but Pisces. Any thoughts? Anyone know anything?
What is Pisces?
What is Pisces? Well, it's not your star sign. So Pisces stands for the Private Intermittent Securities and Capital Exchange System. Now, this was something that the government is looking to bring in, and it's expected to be a bridge between private and public markets. So offering liquidity in the shares of private companies without the expense and regulatory burden of IPOs. I think this... I mean, like a few things in the budget, we don't actually know the detail. But for me, I think this is interesting, obviously coming from a trading floor as Steve has. And one thing we've found is VCTs, the perception that there is a secondary liquidity point helps, I think, drive people to want to invest in something, even if you look, they are long-term investments and you might want to hold for longer purposes, but just to know that you've got a potential exit. To me, I think SEIS funds and EIS funds have struggled recently because people are like, oh gosh, there hasn't been some exits. They've been held back with COVID, the pandemic. And so I think this might kind of encourage just even perception that there are exits available, with lack of IPOs as well.
And I'm happy to jump in here because so with EIS especially, it is effectively a long-term hold, so 5, 7, 10 years of illiquidity before any exit is likely to happen. There are circumstances maybe earlier, but it is on a company-by-company basis. And if you have a fund of 10 or 12 companies, that creates quite an illiquid part of your portfolio. And any action to create some liquidity in that, or as you say, an option for liquidity, it gives them lots more reassurance. And the reason that the EIS and early stage company are high risk is the illiquidity. It's not the risk of business failure, it's the illiquidity, which the FCA defines these companies as high risk. So any mechanism to get some liquidity, which then can be recycled and reinvested or reallocated, may go elsewhere. But that's the point. Having some liquidity just reduces the risk profile.
Yeah. Any further thoughts?
Yeah,
Nick?
I mean, I totally agree with that. I suppose that in terms of types of business you're talking about there, Paul, it's yet to be seen how much of an impact it would have. Because it's not really for retail investors. It's not going to help them with capital raises. So, but then on the other hand, it will make it easier for. The disclosures required for listing is probably one of the things that put people off. So, it might have an impact on that. So, potentially open.
I think, and they are talking about initially it not being for raising capital, but down the line it might become something. There's a lot of discussion. I think it's one to watch, as I said, and something that could be positive for the marketplace. Right, I think that's pretty much. Anything else that anyone wants to touch on, or I think we are coming to an end on our budget.
I was going to say, we were talking about inheritance tax earlier on. And I think we were talking about, the budget obviously is a great result. From an inheritance tax perspective, if we can end on a little funny story, if you like. This is about. You should be.
Is he in it?
No. He's not.
Okay.
Well, I don't know. No. It was about the perception conversation. It's completely different to the point that I was making before, but in the wake of that whole discussion, we had a lot of discussions about IHT and what we thought might happen. I'm glad we're doing this after the budget because we could all look very stupid, within minutes.
Which could have gone
But actually,
very wrong.
in that same week we were talking about this originally, we had a conversation with somebody who wasn't Paul and will remain nameless about inheritance tax. And this shows, really actually, for your audience, the importance of good advice, but it also shows the misunderstanding around inheritance tax, where we'd met somebody who told us that they didn't have an inheritance tax problem because they were dealing with their inheritance tax problem by saving up money to pay their inheritance tax bill, which was interesting in itself because they didn't quite understand that just saving the money in a bank account meant that they would have been
increasing.
It would increase in the problem. And then you got out your calculator and did a little calculation and realised they didn't have an inheritance tax problem in the first place. So I think that sort of plays to.
We'd love to know who their advisor was.
Yeah. Well, I think
maybe they need an advisor.
Yeah, we pointed them in the direction of advisor. Yeah, not for inheritance tax purposes though.
Oh, okay, perfect. Right, well, with that, we're going to thank our guests, both Nick and Paul. And next week, on the next podcast, I think we're going to look at imminent tax year end. So, yes, watch this space. Thank you, guys.
Thank you.
Thank you.
Thank you.